Good morning. How's everybody doing?
Good, and you?
Good.
All right, good morning. Can you hear me?
Good morning, Vanessa. Hold on.
Yeah.
Give me, let's wait about 4 more minutes for other people to join and then I'll take roll call. Okay?
Sounds good.
I am here. Sorry that I'm late. Yeah.
Okay, Ms. Tonga, welcome everybody to the Youth Empowerment Economic Club, High School Edition. We have our fearless leaders this morning, Ms. Vanessa Tonga and Mr. Daryl Rayford, and they're going to start you off. I'm going to take attendance at the end of class. So Ms. Vanessa and Mr. Darrell, go right ahead.
Good morning. I'm in the process of doing some honeydews. Honeydews are when you do all the things your wife tells you to do. Honey, do this, honey, do that, honey, do this. And that's what I'm in the midst of doing. So I apologize for my outfit, but go Raiders next year. I'm glad we're here again today. Ms. Tonga, I appreciate you doing this for us. Your mic is on mute. I don't know if you're on phone.
Tell me, can you hear me okay?
No, you got the echo. No, you got the echo. Hey, Rhonda?
Oh, how does this sound?
Still an echo. Hey, Rhonda?
Yes, Mr. Rayford.
Just so you know, Cox Cable increased my internet by $30, so I may not have cable for the rest of my life. That's not
Okay.
that's Rosalind's bill.
Okay, got it. Okay, okay, let me,
We're talking about finances here, kids, and Cox Cable is getting ridiculous.
okay, so I have made you the co-host, Ms. Tonga. So you are ready to rock and roll.
Okay. Can you hear me okay?
Yes.
Perfect. I'm gonna share my screen. All right, can you see my screen?
Yes.
Perfect. Good morning, students, young leaders. Hopefully you had a great week. Today we will be talking all about credit. And this is so, so important. As you know, throughout this training session, you've heard about how credit is important for getting an apartment, credit is important for buying a car. So basically, credit will follow you all of your life. So this is going to be a really, really important topic. So I'm going to go ahead and get started. And then after this video, I'll see if Mr. Rayford has some words.
Okie dokie.
When my friend's car broke down, I loaned him $300. Then my friend, the car, and the money all drove away never to be seen again. A total disaster. But it did teach me a very important thing about lending. Trust. You see, lenders will loan you money if they can trust you to pay them back. We'll show you how to earn the trust of banks and credit card companies so you can establish and build good credit. That way you have the flexibility to borrow money when you need it.
Oh, sorry. All right, Mr. Rayford, any words about credit before we get started with this quiz?
Well, yeah, take it seriously. Let's see what the program gives us. And I'll add in where I can, but take credit very seriously. Right now, you guys already do credit whether you realize it or not. You've lent your friend 50 cents, $1, $5, $10. And then when he never pays you back, he comes back to you and says, can I borrow $2 or $5? And you look at him like, hey, you still owe me $5 from the last time. Oh, do I? So that person's established bad credit and bad faith. So we'll get into that as we get into the presentation. Thanks, Ms. Tonga.
Okay. So what we're going to do is we're going to do a credit quiz. So on the left-hand side is going to be the words, and the definitions on the right-hand side. And once again, you know, we love everyone to participate. So this is not just us speaking to you. We would love you to participate. So go ahead and take your mics off of mute, and let's see if we can do this credit quiz. So when you think about the credit score, what on the right-hand side would be credit score?
The last one.
Okay, credit score, the total cost of credit expressed as a yearly rate. We'll put that there. For APR, what do you think APR is?
A loan repaid in equal amounts.
APR, okay. And then installment credit,
The ability to borrow money when you need it.
okay. And revolving credit. I guess the last one would be, what did we not use yet? I think it's numerical rating lenders use to make approval. Okay, so let's see what we got. So installment credit would be a loan repaid in equal amounts over a period of time. APR is actually the total cost of credit expressed as a yearly rate. Revolving credit is the ability to borrow money when you need it, kind of like a credit card. And credit score is a numerical rating lenders use to make loan approval decisions. So we pretty much had everything wrong, but that's okay. We're gonna learn all about this. So the first thing is, what is credit?
Credit means being able to borrow money from a lender with a promise to pay them back, usually in monthly payments. Car loans, student loans, credit cards, and home mortgages are all examples of credit.
The lender makes money by charging you an extra amount in interest and fees over and above the amount of the loan itself.
How much will borrowing money cost you? It mostly depends on three things: how much you borrow, called the principal, how long you take to pay the money back, known as the term,
And the interest rate you're being charged.
right, and lenders will only loan you money if they have trust and confidence that you're able to pay them back. Earning their trust is called establishing credit.
Every time you borrow money and keep your promise to pay it back, you strengthen your ability to borrow again the next time. That's called building a good credit record or a good credit history.
Using credit can help you reach your goals, but remember, credit has benefits and risks.
All right, kind of just like Mr. Rayford said, you're dealing with credit right now. When you let someone borrow $10 and then they pay you back, they're establishing their credibility with you. If you give somebody $10 and they're supposed to pay you back next week, and it takes them 2 months to pay them back, next time they ask you for $10, you'll be less likely to consider giving it to them. So that's the credibility you want to establish with people and organizations. So a few concepts. Credit is the ability to borrow money. Establishing credit is about gaining the trust of the lenders. Borrowing is the responsibility to repay loan payments, interest, and fees back. Cost depends on the interest rate and how long it takes you to repay. And your goal is to achieve a good credit history. So we're going to look at some credit risk and benefits. All of these people have credit, but some have borrowed more than they can comfortably repay. You never want to do that. So let's see what they have to say. Having good credit made it easier for me to rent an apartment and get a service from local utility companies when I moved in. Good credit also gives me the option of buying things now, like a sound system and a cell phone, and paying the money back over time rather than having to wait. So she had good credit, so she got the apartment, and even to get like electricity and gas, oftentimes you still gotta have good credit for that as well, or they'll ask you to put a lump sum down just for like in case you don't pay them back. So for this person, when I got my first credit card, it was so easy to spend. I started overdoing it, spending a lot more than I had cash to spend than I would have if I spent cash. Now it's a real struggle to pay it back. I had to pay a few things late, so now I'm losing money on late fees. Yep. So if you pay late, they will actually charge you more money because you're paying late. So now this loan is costing you more money than you even expected. I don't want debt problems, so I follow 2 guidelines. I never let my credit card get over 20% of the yearly net income. Plus, I keep my credit card debt low so that my required payments are no more than 10% of my monthly income. So for this individual, they got a strategy. First things first is they don't let their credit card go over 20% of their net income. And then they make sure that their payments are going to be no more than 10% of their monthly income. So don't spend more than you even have. It's basically the point here. Ooh, I really messed up on my credit because my credit rating is so low. It's going to be tougher for me to get loans and credit next time. Even if I'm able to borrow, I will have to pay higher interest rate. And yep, and that's what happens. If you start paying late, the next time you do borrow, they may let you borrow, but they'll charge you more money. I didn't make some loan payments, and that really hurt my credit score. I missed out on an apartment and even got turned down for a job because of it. A lot of companies will look at your credit score to make sure that you're a trustworthy person. With good credit, it's easier for me to buy what I want when I want it. I have financial flexibility to make major purchases that take more money than I have on hand. I just bought a great car. Good credit has given me a chance to act on life opportunities. I'm going to borrow now to go to college. All right. So here we talk about good credit and bad credit. So to the right, good credit is paying at least a minimum required payment, paying on time, never missing a payment, and staying within your credit limit. But then what happens is it's easier to borrow more money and you don't have to pay extra fees. When you have bad credit, you're paying too little, too late, missing payments, and going over your credit limit. So that's going to make it harder for you to borrow money, and then you lose money in late fees. So how do you establish credit? Get a bank account. Never overspend. You can get a gas or a store credit card and make sure that you're paying your bills on time. Take a small loan and repay it monthly, in full and on time. Get a secured credit card linked to a savings account. And this is a really good option. So if you have a savings account, you can actually get a credit card. So every time you're using it, you're actually using real money, so you never overspend. Unless you go negative. And then here are 5 C's of credit. Mr. Rayford, can you, on a high level, kind of go over some of these?
Sure, no problem. The 5 C's of credit, character. Well, that's very important. I'm not going to read all this detail, but when I got into banking, my background is finance, and I worked my way up the corporate ranks, and then I moved into banking because I felt that because I didn't have my certified public accounting certificate, I needed more of a background. So I knew how to read financials, but when I got into banking, one of the lessons that I learned, when you're giving credit, you have to meet the people who's asking for credit. And I wasn't meeting individuals, I was lending to corporations. So the lesson that I learned there was meet the CEO, meet the CFO, meet the people who have to pay you back, because it's their character, not the financials, that are going to pay you back. Capacity. Capacity refers to considering your other debts and expenses. What are your limits? How much do you have? Don't overload yourself. Capital. Capital, it refers to your net worth. This is what I have, and these are my debts from which I purchased these items. When I take my things that I have minus my debts, the things that I have are considered assets. Minus my debts, you guys know that, is your net worth. So a lot of people say, I have a house when they first buy a house. No, the bank owns the house. And as you pay incrementally the bank, you have more net worth in that house. Collateral. Collateral refers to an asset of a borrower, for example, a home, that a lender has a right to take ownership of and use to pay off debt. Well, another thing that we talked about in another session, we talked about the United States having gold. Gold used to be the backup of the dollar. That's collateral. What do you have so you could support what you borrow? Banks will always ask you, how much skin in the game are you going to put in? And conditions. Lenders consider a number of outside circumstances that may affect the borrower's financial situation and the ability to repay. For example, what's happening in the local economy? If the borrower is a business, I can't even read that, the tender may elevate the financial wealth of the borrower. Bottom line is, let's use the housing market as an example. Right now, it is a buyer's market. That means that there's more houses in the market than there are buyers. So buyers have power to buy a home at a reasonable price. However, outside condition is interest rates. Interest rates have gone from, and Ms. Tonga, you could explain this better than I can. Interest rates have gone from 1% to now approximately 6% on a house. Cars have gone from about 4% or 3% to about 8%. So pay attention to the environment that you're in because it's constantly changing. Ms. Tonga?
Right. Yeah, and just to add a little bit, when you're talking about collateral, we talked about how sometimes a friend may ask you to borrow $10 and then you let them borrow. So when you think about collateral, imagine if someone asks you to borrow $10 and you say, sure, I'll let you borrow $10, but let me borrow your jacket. So that way, if I don't get my $10 back, I at least got your jacket, or I got this cool one of your shirts. So that's kind of collateral when someone wants to make sure that you have, they have something that they could take back in case they never get their money back from you. So that's collateral. And then when you're thinking about like interest rates, it's kind of like right now, if somebody will say, hey, you will say, you know what, you can borrow the $10, but when you bring it back to me, I want $11 next time. So they bring you back $11. Well, interest rate is like when it costs more to borrow the same amount of money. So the next time you go to the person and you say, hey, let me borrow $10, that person may say, okay, this time I want back $12. So that's what, like, the interest rate going up. So those are the things you want to be aware of. Because it all boils down to your credit score. This is what lenders are going to be looking at. And your credit score basically is going to be, how credible have you been? How have you been paying all your debts on time? Have you stayed under the minimum of how much you could borrow? So let's listen to this video.
Lenders always want to know the credit history of people who ask them for credit cards and loans. To find out, they turn to credit bureaus.
Credit bureaus keep track of almost everybody's credit history information. Things like how many credit cards you have and how much you owe, whether you pay your bills on time, where you work and how long you've worked there.
In addition to your credit history, almost all lenders look at your credit score. This is a number that indicates how reliable you are at paying back your debts. A computer program analyzes your entire credit history and generates a single number or score, usually ranging from 300 to 850. This score helps lenders decide if you're a good credit risk or not.
Okay, so your credit score is going to be really, really important. You want to be as close to that 850 as possible. Typically, if you're over 700, that's considered really good, especially like over 750. So how does your credit score impact you? It impacts you by the ability to get credit card, ability to purchase a home, whether your landlord will rent you an apartment, the interest rate lenders are likely to offer you, the amount of insurance premiums, your ability to borrow money, and whether you can get service from utility companies. So when you think about renting an apartment, let's say you have somebody that had a score of a 400 and then somebody that had a score of a 750. Which one do you think the landlord would want to rent to? The person that has a 400 or a 750?
750.
750.
Yep. And why is that?
Because it's closer to the 800.
Yeah, and basically what it's showing is that basically this person is trustworthy. And the thing is, when somebody's paying you rent every month, you want to make sure that it's somebody that you actually trust will be paying you, because oftentimes landlords are still paying the mortgage on the home. So you want your tenant to pay you on time so that you can pay your mortgage on time. So you're not going to have somebody that's kind of shady and doesn't pay their current bills on time, because it shows that they're not credible. So how can you impact your score? Improve your score. Do these 5 things to improve your credit score. Lower your score. Don't do these 5 things. Hold on. Am I missing something? Oh, I am. Hold on. Okay. To improve your credit score, do these 5 things. Pay your bills on time. Keep track of your credit cards. There are 70% or less of your spending limit, meaning you want to make sure you're keeping it less than 70%. Only apply for and open new credit accounts when you need them. Have high income relative to how much you owe. And have a great credit history for a long-term period. Now, these things are going to make your score bad. Paying some bills late, having credit card balances near your maximum spending limit, applying for new credit cards frequently, whether you need them or not, having a brief credit history, exceeding your credit card spending limit. Another way to help improve your credit score is to have a mix of revolving credit and installment credit. So revolving credit is going to be like your credit card, where you have a credit line of 1,000 and you can borrow and pay it down, borrow and pay it down, and your credit limit is $1,000. An installment loan is kind of like a car loan. You buy a car for $10,000 and you pay over it on time, and it goes down, 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 and you don't get to borrow another $10,000. You're just paying down the loan that you got. And of course, all of this goes into a credit report. And before I go into this, I'll see Mr. Rayford wants to add anything. But basically, everything that we're talking about, because a lot of times people don't think that it matters, but all of this information goes to an agency, and there's a report out there that companies can go in and see what your trends are. Mr. Rayford?
Nothing much, just a personal story that I think I mentioned this before. One of my former bosses at CBS television said to me, maintain good credit. Even if you go into the store, buy a pair of socks on credit, and then pay those socks off. The next time, buy a pair of pants, pay those pants off. So take credit seriously. Another analogy that I have with credit, so you can take it seriously, is a hot stove. You don't put your hand on the fire to see if it's hot. You already know it's hot. So take credit seriously, because it's going to come back when you want to buy something. So I don't know if that's a great analogy, but take credit seriously.
Yep.
Thanks.
Yeah, because in this scenario, Rachel plans on moving out of her sister's house and to rent her own place. So what she did is something really smart. She reached out and got a copy of her credit report. Because you can always get a free copy once a year of your credit report. You just have to reach out to one of the 3 agencies. So when she got it, what she noticed is that it showed that she was late paying 120 days of $1,275 from a national chain, clothing chain. So it was like a credit card, but she's never shopped there. So given her situation where her credit report shows that she is late paying on a credit card that she never used or a shop that she's never gone to, what's the best option for her? So take a look at these 3 and let me know which one you think is the best option.
The third one.
Yep, the third one says contact the credit bureau immediately. Also contact the billing department for the clothing company. So if you see mistakes on your credit report, you want to reach out to the bureau to let them know it's a mistake. And then also the company that is showing, you being late or having a credit card that you don't. You never not want to worry about it because it's going to follow you for the rest of your life. And calling the store is good, but you want to make sure that the credit bureau knows it's a mistake so they can fix it on their report that many people will see.
If I can add, Ms. Tanga, you have to be relentless when you are calling the credit bureaus. If you see something on your credit report that is in error, write a letter, call, write another letter, call, write another letter, call. That's how relentless you will have to be. You're in an environment of information technology, and a lot of times people will not be able to fix your situation. So in order to get something fixed, you have to, and I underline have to, you have to be the squeaky wheel, because if you're relentless, the credit bureau will contact you and you have those letters to substantiate that you've been trying to clear this up from whatever date. You have to be relentless. Thanks, Ms. Tanga.
Okay, and next we'll watch a video about what is a credit report. And while we're watching this, Mr. Rayford, it looks like we have something in the chat. So if you could, it doesn't work on my side, but if you could take a look at the chat and then let us know if there's anything that we need to add or if that was something important to add to the class.
No,
And I'll go ahead and
somebody just came on board and they just want to let us know they're present. Okay, we're good.
Awesome.
The complete written version of your credit history is called your credit report. You should review your credit report at least once a year to check for errors or fraud. And it's a good idea to review it before making a big purchase like a house or a car.
Also, keep in mind that you give others permission to look at your credit report when you do things like fill out a credit card application or apply to rent an apartment.
That's right. Many landlords do a credit check to decide if they can count on you to pay your rent. And some lenders study your credit report to decide whether or not to offer you credit.
Last but not least, an employer might check your credit rating when you apply for a job. If you have a good credit score, it shows them that you're responsible and more likely to be responsible on the job.
Yep, very true. If you're a responsible person with your money, then most likely you're a responsible person at the job. So when people are looking at your credit report, like they'll look to see, for example, let's say you have like $50,000 in credit card debt, but then they know that you only make $1,000 a month. Employers and even car companies and rental landlords, they're going to see that and say, wow, this person is overextended because they got so much credit card debt. So don't think that nobody can see it. So credit report information It's your credit. It's a written history of your credit. The credit bureaus maintain the data. You can request a credit report. Others can request a credit report as well, and lenders and landlords always use them. How do you obtain your credit report? The Fair Credit Reporting Act allows you to receive one copy of your credit report once a year from each of the 3 largest credit bureaus in the United States: Equifax, Experian, and TransUnion. To get a free report, go online, go to their jointly run site, www.annualcreditreport.com. So if you guys go there, you can actually request your credit report now. Be wary that many of the websites that advertise free credit reports, many consumers get tricked into paying for reports and services they don't really need. The only website providing you a free annual credit report is the one we mentioned, which is run jointly by Equifax, Experian, and TransUnion. And the 3 credit agencies, because they do the math a little bit different, and some organizations prefer to use one over the other. So you want to look at all 3 of them to see what your score looks like. When you receive your report, check for mistakes in your name, social security number, address, and accounts that you didn't open, and any errors. Okay, how do you read it? You'll have your general information, name, social security, address. It'll tell you if you have any public record information like bankruptcies. And if you fail to pay back on one of your creditors, they may hire a collection agency to contact you. So any collection agency account information will be listed. And then it lists the companies that have requested a copy of your credit report for their review. And that's important because people will look, they will look to see how many people you're requesting credit from. So let's say I'm purchasing a car. So I go to different lenders to see how much my interest rate would be. Every single time that I'm writing an application for credit, the credit bureau knows it and they're tracking it. So the more credit the more applications you put in there, it actually kind of can reduce your credit score, because it looks like you're just trying to find money anywhere, anyhow, and that looks kind of bad because it looks like you're a little desperate. Credit cards. This is what everybody likes these days, right? Ryan's been working to save money for school next fall. While he's at work, his motorcycle gets clipped by a pickup truck. Wow, and crashes over. As a result, a bent foot peg, a broken lever, a smashed signal, and scratched paint. It cannot be fixed, but it isn't in his budget unless he pays some bills late. He needs his motorcycle to get to school and work. So given his circumstances and these 3 choices, how would you advise him to pay? So number 1, use his debit card and pay all his other bills late. He needs to get to work and not take on more debt. 2, use his credit card so he can get it all fixed fast, keep working and earn the money to pay it back. Or 3, use the money he saved so far. Savings are for unexpected emergencies like this. So what should he do? Pay his bills late so he can fix it with his money, use a credit card so he can get it fixed fast, and then just pay down the debt, or use his savings, since savings is for emergencies. 1, 2, or 3?
3.
I'm thinking 3, but I also am leaning a little bit towards 2.
Okay. Let's try 3. Number 2, use his credit card so he can get it fixed fast while keep working and earning the money to pay it back. And then I'll ask Mr. Rayford to give some insight on this. It may kind of seem kind of like, whoa, well, if you have savings, it is for emergencies. But here's the good thing. If you have a credit card and you know you're still working and you still have savings, you can use the credit card to get it fixed. And then each month you're paying down that debt, yet you still got the savings in case there's another emergency. So that's one way to look at it. So, I mean, you could have used all of your cash out of the savings and then just had credit, but then Sometimes there was some emergencies, you actually need cash and not credit. Mr. Rayford, what would you say to this one? It's a little interesting.
That's a tough one.
Hmm.
And I go with the gentleman who said number 3 and number 2. Here's what you really need to do. And most financial people will not tell you this. You have to have a savings account. You have to have a checking account. And then, as Ms. Tanga said, you have to have an emergency fund. That emergency fund is not your savings account. And see, people think the savings account is the emergency fund. The emergency fund is for emergencies. And because you guys are very, 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 very smart, you understand that if you use your credit card for number 2, you will be paying 12 to 20% on that money if you have a line of credit, if you have the ability to credit. If you have overextended yourself and you don't have any money, your car is going to be broken, okay? And that's just the way it is. But if you put a little bit of money in an account and you just say it's a saving, it's an emergency fund, it's not savings, it's not checking, it's for stuff that happens, you'll be in better shape. So it's pros and cons to both of them, but the best thing to do is you be your own finance person and minimize the risk so that you can keep on functioning. One of the things that I do in this household, and everybody's different, I put $20 in the glove compartment of the cars that we drive. So, you know, like Ms. Tanga says, some people don't take credit cards, but there's $20 in every single car. Every single car has $20 in it. So, you know, that's me. So, you know, you guys got to be you. So that's what I have to say on that.
Yeah, actually, I love what you said, because there is a big difference between having an emergency account and then having a savings. Because with savings, you really want to like have it, as we talked about it in the past class, you want to have an automatic way to put money into savings. Like we talked about, every check, you put $20 away and you don't even think about it, and it's just kind of gone. And then you can also have like another little account where you put in maybe $5 for emergencies. And over time, that $5 can grow to $100. And then if you have an emergency, that's going to be the cash you go to, the emergency fund, meaning that the other $20 each month, you don't even touch that, because remember, you're not even thinking about that. That's a savings for something bigger. Meanwhile, you have an emergency fund. Like one of the things that I like the idea of is saving like $2,000 for emergency, and then everything after that is for your savings. At your age, you may not need $2,000 in emergency fund. So maybe for you, it's saying, you know, if I have $100 for an emergency fund, that'd be sufficient. And then after I save that initial $100 for an emergency fund, everything after that just goes straight to savings. Everything goes to savings. And like we said, you can't always use credit cards for emergencies. Like somebody comes to you and they say, hey, I have an emergency, I need to borrow, $20. You're not going to give them your credit card. So having that emergency fund and that stash is really good. So there's a difference between emergency and savings. Savings you don't want to touch. It's really good.
And another thing is you may have a goal set and you don't want to touch savings. So you may want to say, okay, I got an emergency fund and I put $10 in there a month and now I've got 2,000. Well, I also want to buy a house in 10, 15 years. You may want to put $100 in that. And when it comes time to buy a house, you have the money for a down payment. One of the things that we have as a society is we don't value money. We don't understand money. And I'm not saying be cheap or something like that. No, I'm not at all. But I'm saying plan. As you well know, I am the CFO of the 100 Black Men of Las Vegas. And when I came on board, we were a $75,000 business. And what that means is we spend about $75,000 every year. And when I came on board with the mindset of what I'm telling you, I went to the board and I said, can I put $5,000 a month away? And, you know, $5,000 wasn't a big deal to anybody. So they said, sure. I'm happy to say now that we have close to $150,000 over the past 2 years when I asked them to do this. Now I have board members say, well, why can't we do this? Why can't we do that? Why can't, because the mindset wants to spend. And I said, no, this money is dedicated for us to buy property. Buy property with this money, meaning my goal is to have $1 million or $2 million in the bank, right? And then have that money work for us, say at 5%. $1 million at 5%, the 100 will get $50,000 a year in interest. $2 million in the bank, 100 will get $100,000 a year. So forever. So therefore, we don't have to rely on dues. Our money will be working for us to pay for a office. Does that make sense to everybody? Ms. Tanga?
Okay.
Okay.
All right, the basis of credit cards.
When you shop or pay the bills, how do you pay for things? Cash? Debit card? Maybe sometimes you use a credit card.
If you do, here's the important thing to remember. If you repay what you borrow over time, you'll be charged interest each month on the amount you still owe. So with a credit card, the total amount you end up spending on things may be quite a bit higher.
But if you pay off your purchases by paying your first credit card statement in full within the grace period, you'll pay no interest. Plus, you'll have your full credit limit available to use again.
And take it from us, once you have a card, it's very easy to use it. But to use credit cards the smart way, you need to know the basics of what they are and how they work.
Okay. So credit card facts, applying for a card. When you apply for a credit card, the financial institution will check your credit history and decide whether or not to give you a card. They will also decide how much you're allowed to borrow or charge. This is called your credit limit. So when they're looking at your background, they're going to make a decision, like, do you get a $1,000 credit limit, or do you get a $2,000 credit limit? A lot of that's going to depend on how much money you make, and then also your credit score. Every time you use a credit card, you're actually borrowing money from the financial institution that issued you the card. The financial institution pays the debt to the store for what you bought. Then you pay the money back to the financial institution. Remember, debit cards work differently. When you use a debit card at the store, you have the option of selecting debit and entering your PIN, or credit and signing your name. Either way, the money is deducted from your checking account. So a debit card is attached to your checking account at the bank. It's taking money, real money that you already have, and you're using it like a credit card. Whereas a regular true credit card, you're borrowing from that company and not your own money. And then later on, you're paying back to that company. So they're basically fronting you the money. Interest rate. Interest is the amount of money paid by the borrower to the lender in exchange for the use of the lender's money for a certain period of time. You earn interest. You earn interest from the bank if you have savings account, and you pay interest to the lender if you have a loan. The interest rate is the amount of interest paid per year divided by the principal amount, the amount loaned. For example, if you paid $500 in interest per year for a loan that is $10,000, the interest rate is $500 divided by 10,000, or 5%. So remember when we talked about having a savings account and how the bank gives you money? They give you money because they're holding your money. But what the bank does with your money is they loan it out to people that need it, and then they charge them even more money. So they'll charge the person like 20%, and then only pay you 5% for borrowing your money. So they get that spread. So the difference in the interest rate is how they make their money. Revolving credit. Credit cards are called revolving credit because you pay the money back, your credit becomes available to you to use again. So if you have a $1,000 credit limit, you use, let's say, 50 bucks. Once you pay back the 50 bucks, you're back at the $1,000 credit limit. So you basically borrowing, paying back, borrowing, paying back, and you'll have that $1,000 credit limit. A secure credit card is a credit card backed by the savings account. The money in the savings account is collateral, which means it may be claimed by the savings, by the company issuing the card if the account holder fails to make the necessary payments. So when you have a secured credit card, you're using a credit card, but the bank knows that they can just go ahead and use the money out of your account. So they know that it's covered. So you put in $500 in a secure credit card, your credit limit is $500. Put $1,000, it's $1,000. And then now we're talking about annual fee, finance charge, and grace period. Some financial institutions charge an annual fee for the credit card. This is the fee, is the amount they charge a credit card holder to use their card for a year. The term finance charges means the amount of money a borrower pays the lender for the privilege of borrowing money, including the interest and other service charges. The grace period is the length of time as defined in the card member agreement between the use of the credit card to make a purchase and then the start of the interest rate. So they said it a little bit in the video. If you have a $1,000 credit card, for example, and you borrow $250, as long as you pay it back before the charges start accumulating, you only have to pay back $250. But if you wait longer, then they start charging you that interest rate. So if you could pay off your credit card prior to the charges starting, you're not paying anything to borrow money. And that's the best way to do it. And then every month you'll get an email or paper statement just showing you all your charges. And you always want to make sure that you're looking at the credit card statements to make sure that they're accurate. Okay. So go low and repay fast. Credit card companies will send you a monthly bill or a statement showing how much you have borrowed. The example below shows how to save an interest. So let's say you purchased a new laptop for $500 on a credit card. Review the chart below to see what you really pay when you're using a credit card with a higher interest rate and one with a low interest rate. So with both examples, you borrow $500. The first one, your interest rate is 8%, and you pay it within 6 months. Your total interest is $10.25. So the total price was $510.25. Here, your interest rate is higher. Maybe you have bad credit, so they're charging you more. And then it takes you 24 months to pay it back. Your total interest is $99.09. So your total price is $599.09. Which one is a better deal?
The 8%.
Yeah. And then by paying it for a less amount of time, your total price ends up being lower. Now, you could use a credit card, but what if you saved for this laptop? If you would have just used your savings account, put in $50 a month, got some interest, depending if you have an interest-bearing savings account, and then saved $500, so then you probably would have paid less overall, and the bank would have given you some interest on top of that. So there's a difference between saving your own money or using a credit card and then later paying more. But let's say you have to start school next week and you need a laptop now. So then in that situation, you leverage your credit card. In your percentage rate, express the total cost of your credit as a yearly rate, taking into account a loan's interest rate, term, and fees. The lower the APR, the lower the total cost of borrowing. All right, killer credit card tips. And then after this, I'll see Mr. Rayford wants to add anything.
Most people spend more when they use credit cards instead of cash. So it can be easy to drown yourself with credit card debt before you know it. We don't want that to happen to you. Have a budget in mind before you spend, and don't spend what you can't pay back.
Remember, when you use your debit card, the money is deducted directly from your checking account. But with a credit card, you're borrowing the money. So again, before you charge, you need to think through how you're going to repay.
To keep your credit card spending under control, start out by selecting just one category to charge at first, like gas or groceries. Don't add a new category until you're sure that every month you can repay what you borrow.
Also, try keeping your credit card balance below 70% of your limit, and keep your credit card debt low enough so that your required payments are no more than 10% of your monthly income.
Yep, those are really, really good tips. Mr. Rayford, anything you'd like to add?
Basically, be aware of your money.
Yeah.
We're giving you some advice. You could either ignore it or you could listen and understand the environment that you are in here in the United States. The United States is the biggest spender in the world. The biggest spender in the world. And the Black community is the biggest spender proportionately in the United States. Why? Because we buy, when I say we, the United States and the Black community, we buy based on emotion. I have to have those Air Jordans for $500. I have to have a Mercedes-Benz 300. I've got a client that spends almost $900 a month on his Audi, whatever you want to call it. And I said to him, I said, your payment is $900 and my car payment is $300. I got $600 to do something that I feel like doing versus you're tied up in this car. And he said to me, I didn't think about that. This country is marketed by marketing people very aggressively. We watch commercials all the time. You have to be on top of your money. Again, am I saying be cheap? No, but be aware of your money. Thanks, Ms. Tiger.
Yep, be aware. And as Mr. Rayford said, this is pretty much straightforward today. It's just, we've been talking about all the things that you wanted to do, having goals, savings, and now we get into the credit training. And I'm kind of glad of how this coursework went, because at this point now you already know it's really important for everything else that you want to do. So when you're looking for credit cards, you want to look for one that has a low fee and low interest. So there's going to be a lot of credit card companies. Some of them give you cash back for like travel. Some you get cash back if you go to restaurants. So the most important thing is making sure that you have one that's going to charge you the lowest amount of interest. You want to be able to pay off as much as you can. You don't want to, you don't want to charge $2,000 and you're only paying the minimum every month is $10. How long will it take you to pay off all $2,000 if you're only paying the minimum? So you want to pay as much as you can. And that's why it's important to make sure you can afford it. You don't want to go borrowing so much money and then you can't really afford to pay it back. Because don't forget, other emergencies are going to be happening. And then you never know, you could lose your job, and then what? Keep within your limits so that way you're not overextending yourself. Pay it on time, and then avoid cash advances. A lot of credit cards will let you borrow cash, meaning you go to the ATM and take cash, but to be careful because a lot of times that cash interest rate is higher than just charging. So you go to the store and, go to Marshall's and charge it, and it's 24% interest rate. But if you go to the ATM and take out cash, they may charge you 35% on that money. So be careful. And that's why you want to have a savings and get debt help early. If you're getting in trouble with your debt, you want to go ahead and call the companies, let them know you're falling behind. See that they'll work with you. How to read your credit card statement. A lot of times you'll have the credit card number on there. You will see basically what the closing date of the statement is. And you're going to want to know what these dates are, so you're always paying your bill on time. It'll tell you what your credit line is and your spending limit. It'll tell you how much money you borrowed and what's still available to you. It lets you see each charge. You want to follow up and make sure you really use that money and it's not a mistake. It'll give you a summary of all your transactions. And then it'll give you some options as far as payments. It'll show you like the minimum payment, and then also it'll tell you most of the time how long it'll take you if you only pay that minimum payment. So take a look at that. It'll tell you your due date. It'll show you your rates of the interest that's being charged and how much it is. And payment coupon repeats the current payment information. Safety. If you lose your credit card, you want to call the company immediately so nobody's charging it and you have to pay it back. You want to sign the back of your credit card so then that way people can compare it to when you sign your receipts. Treat your credit card like it's cash. Protect your cards as if they were cash. Never let them out of your possession or control, and definitely don't give it to anyone. Don't leave it in your car. Because a lot of times when people go into your car and break in, they will take your credit cards, and they can usually spend it. When shopping, make sure you get your card back after every purchase. Check the sales vouchers for correct purchase amounts before you sign them. Always keep copies of your sales vouchers, which is your receipts, and credit card receipts. Don't volunteer any personal information when you use your credit card other than displaying the ID if they request it. And then watch your accounts, monitor them, and avoid magnets. Keep your cards away from things with magnets, which can erase the information stored in your card. And then also be careful when you're using ATMs to make sure that there's no kind of device on the ATM that when you swipe your card, it may be stealing your credit card information. I've never run into it, but be careful. Okay, so how should Ryan respond? A few days ago, Ryan was browsing online for discount airfares. He followed a pop-up app on a website and entered his email address and received a special sale update. Today, he received an email telling him he would win some cool luggage, plus qualify for a 3-night trip to Cancun, just by emailing back his profile information, which includes his credit card information. Given his situation, what should Ryan do? Provide them the information. He already won, and they can change, and he can change his credit card without permission. Oh, and they can't change his credit card without permission. That's number one. Number two, don't email back. It looks like a scam. Or three, it's not safe to reply by email. Call the company and provide the information by phone. What's the best option?
I say either 2 or 3.
I'd say 2.
Okay. Anyone else?
I think 2.
Okay. Yes. Ryan says, man, I'm happy I played it safe. Not responding was the right way to go. I know that one of the ways criminals commit fraud is by directing people to phony websites that look real, and phishing for credit card numbers. I only buy from businesses I know for sure are legitimate. And unless I initiate the communication, I don't respond if I have any doubts about a company that's not worth the risk. So I know for me, myself, I'm always getting emails from my PayPal that says, oh, we blocked your account. Please click here and we can unlock it. Well, one, I don't even use PayPal. I do have it, but I usually don't use it. So a lot of times you'll get all of these different emails. I always go to the actual app and then I'll take a look to see what's going on. I never click on those extra links because a lot of these are phishing now. So loans. Hudson wants to borrow $10,000 to buy a motor scooter and the lowest total cost of credit, at the lowest total cost of credit, while keeping his monthly payments under $400. Which one of these three loans should Hudson choose? A loan is 12% interest with 24 months, 14% interest with 36 months, or 16% interest with 48 months. Which one should he do?
The first one?
The
I
12.25.
think the first one as well.
Okay, yes, because what we talked about earlier was we want to pay the least amount of interest for the shortest amount of time, so then that way we're not paying too much. Oh, wait, I'm wrong. Let's see. Actually, what it says is 14.5% interest with 36-month term. Let me see. Why would that be? No, I think we chose the right answer. Mr. Rayford, do you any thoughts here? I don't think I'm missing anything.
No, number one is the right answer. I think.
Yep.
I think the author or the publisher of this program is going middle of the road, and that's his preference. But I think consensus on this session will go with number one. Here's another scenario. After my lease was up, I had the option with bank to not have a 3-year loan, but have a 6-year loan. So I've already leased the car for 3 years. And the smart thing to do is just finance it for another 3 years and be done with it. But I'm looking at cash flow, and my interest rate is like 5%. And I said to my wife, I said, I'm just gonna go with the 36 months for cash flow reasons instead of paying $400 and some odd dollars a month for 3 years. I'm gonna spread it out over 6 years and I'm paying less now than the original loan. I'm paying $250 a month. And what I've done so far, and I've only done this now, I don't know, 6 months. 3 of those 6 months, I've sent $500 in. So I have control of my money, and I have the option to save some cash because I have a lower payment. Again, it's individual by individual. And that was my choice.
You know, Mr. Rayford, I think you're right on point because what I noticed is it says use the calculator above for help. I don't see a calculator here, but once you said that, you know, the difference in how much money you're paying each month based on the term, because the more time you have, the lower your monthly payment. And in this example, what they said is he wanted to borrow $10,000, but he wanted to keep his payments under $400. So we don't have the ability of using a calculator. So I bet you what happened is if we would have used a calculator, by this one in the middle of the road being 36 months, it gave us an extra year, an extra 12 months of repayments. So even though the interest rate was higher, we had the flexibility to make sure our payment was under the 400. So this is a really good example, and I love your example because it actually put us back on track. So that's what it is. So somebody could say, it's almost like if somebody lets you borrow $100 and then they say to you, well, we want it back next week. You're like, well, I don't get paid but every 2 weeks. So give me 2 weeks, you know. So the person may say, all right, it's gonna take you a little bit longer. I'm gonna charge you a little bit more in interest. So good, I got us back on track. All right, okay, how do loans work? Let's see.
Need money to pay for something big, like a car or college education? You may need a loan. Let's look at how loans work.
With a loan, you receive all the money the lender has approved for you in one lump sum. This is called the principal. Then, to pay the lender back, you need to make equal monthly payments, called installments, for a fixed period of time until the loan is paid off.
The lender may also charge you fees for giving you the loan. On top of repaying the principal, you'll also have to pay the lender interest.
How much interest you'll pay for your loan depends on three main factors: how much you're borrowing, the interest rate, and how long it'll take you to pay the money back. This is called the term of the loan.
Okay, so here we're going to compare some terms. Check out the example with the longer term loan. The total cost is more than 1,100 higher because they're paying more in interest. So this is based on a 10% annual percentage rate. So loan A is 25 months, loan B is 49 months. The monthly payment is $450 versus $250. The total cost of the loan here is going to be $11,106 with a total interest paid of $1,106. Whereas on the right-hand side, they're going to pay a total cost of $12,215, and the total interest paid was $2,215. So you'll see that they had a shorter term, paid more, so therefore their total interest paid was only $1,000, whereas on the right-hand side, they paid less money for a longer period of time, so they ended up paying more money out overall. Please note the final month's loan payment may vary from the regular monthly payment. And then also lenders will often offer the options for the term. You might consider a longer term loan to get a lower monthly payment that you can comfortably manage and pay. And I'm going to go back a little bit. And sometimes with things like this, you have to really think about it. $1,000 in interest, or $2,200 in interest, that's a lot of money. So that's why having a savings account, like right now you're young, if you're able to go ahead and establish a bank account, start putting money automatically to your savings. When you're wanting to buy a car or different things, you'll have more money to put in like a down payment, so that way maybe your term won't be as long and you won't pay as much interest. So the smart people are the ones that find a way to pay the least amount of interest. Here we're going to compare rates. This loan amount is for $5,000 with a 5-year term. So it's 5 years for both loans. Here, this person is paying 5% because they might have good credit, more closer to the 800. And this person is paying 15%, probably because they got bad credit and they're paying more closer. Their score is closer to the 400. Here, you'll see the monthly payments is only $188 versus $237, and in over 5 years, this person's paying about a little over $1,000, and this person ends up paying $4,000, a little bit over $4,000. So you definitely want to get the better interest rates so you pay less money. So loans step by step. So you want to do is comparison shop. Take some time to comparison shop for your loan. When you compare loans, it can be hard to see which one will cost you the least. To make it easier, lenders are required to tell you a loan's annual percentage rate, or APR. The APR is a number that combines the interest rate, the term, and the fees to show you the total cost of the loan. The lower the APR, the lower the total cost. Remember, the loan with the smallest monthly payment may not be the lowest cost overall. Choose a responsible lender. Always be careful when selecting a lender. A responsible lender can help you gain financial flexibility and achieve your goals. To find a responsible lender, look for an established company with good reputation. Ask a money-savvy friend, family member, or employer, or a bank for a referral. Only work with lenders who answer all of your questions. Put everything in writing and give your time to shop and compare before you sign a loan agreement. And this is really important because in the past, even now, sometimes there's going to be lenders that are going to be shady. you may not read the fine print, and it may say something like, oh, to start the loan, they want 500 up front. And if you didn't pay attention, you may have missed that detail. So make sure you're really looking at it in your comparison shopping. Discuss the cost and options with your lender. Carefully study the monthly payment and the APR. Then decide if you can really afford the loan. You want to make sure the monthly loan payment is an amount you can afford, but minimize the total cost of your loan if you can. And thinking about this, probably the first thing you'll ever probably have a loan on, maybe your cell phone. So a lot of the times when you're purchasing a cell phone, you get into a plan, and they may give you options like 3-year or 5-year. Really look at what the options are there and how much it'll cost you overall. And basically what you want to do is make sure you understand what you're signing. So you want to understand that you read all the fine print, you know what the terms are and the cost. I know AT&T, I'm always calling like, now when am I done paying for this cell phone? And for some reason, by the time I'm done paying for the cell phone, it breaks and I need a new one. All right, warning signs to watch out for. Encouragement to include false information. If a lender has changed any of your income or expense information or leaves your income blank, do not sign the loan application. So sometimes the lender may try to be nice and try to help you, and they'll say something like, oh, don't just say you're making $20,000 a year. Let's put down that you're making $200,000 a year. They wanted to give you more credit, like a higher credit line, but you may not need a $10,000 credit line because once again, you want to make sure that you stay within your means. So make sure you're being honest, so that way the company could look at you correctly and give you the proper line of credit. Warning 2, blank loan documents. Never sign a blank loan document or work with a lender who asks you to. Bait and switch sales tactics. When a lender makes a promise or orders in order to make the sale but then backs out of the promise after the sale, to avoid this, it is critical that you carefully read and understand agreement before you sign. Question anything in the document that is not consistent with what you were told. Don't sign the agreement if anything in it is unclear and is not promised. Equity stripping. Let's say that you don't have much monthly income, but you have built up equity in your home. If a lender encourages you to inflate your income on your application form to help get the loan approved, watch out. A predatory lender doesn't care if you can't keep up with the monthly payments, because as soon as you can't, the lender will foreclose on your home and strip you of your equity that you spent years of building. And let me explain that a little bit. You want to make sure, a lot of times, you have a home, so I'm sorry, let me back up a little bit. So let's say you falsify how much money you're making, so now you get to go buy this bigger home, but then later you can't keep up with your payments. The company can take back the house. So even though you've been paying all this amount of money, if you go into foreclosure, you can lose your home and all the money that you already put into it. So you want to make sure that you're being honest so that you can be looked at correctly. Loan flipping. This is when a lender persuades a borrower to repeatedly refinance a loan, often for a short amount of time, charging high points and fees each time. It is not in your best interest because it costs you money and postpones the loan principal from being reduced. So you don't want to keep repeatedly refinancing a loan, because if you have a 5-year loan and they refinance and it starts back over as 5 years, that means you're never going to be done. So make sure that you're not loan flipping. High fees for bi-weekly payments. Some lenders will offer you the option to pay your loan bi-weekly. Also, this is a type of payment plan can reduce the finance charge and length of the loan. Predatory lenders may charge you $1,000 for the privilege of paying bi-weekly. In reality, such accounts can often be set up for free with a few accounts of a few $100s at most. So be careful, read the fine print. Required deed signing if you are behind your mortgage payments. A predatory lender may offer to help you find a new financing, But first, you're asked to deed your property over to the lender as a temporary measure to prevent foreclosure. But then the promised loan never comes and you no longer own your home. So make sure you don't sign away your property. That's basically what it's saying. Advertisements promising no credit, no problem. These are often warning signs of scams. Consumers responding to such an ad are guided by a phony application process and may even receive fake loan approval documents. To receive the approved loan, they are told to pay money up front for fees or services instead of they end up losing their own money. So you don't want to do anything where they may ask you to actually pay them. So if it says no credit, no problem, really be careful. And lastly, promises to refinance in the future. Yeah, so there's times when you'll try to get something and they'll say, well, we're going to charge you 20% now, but don't worry, later you can refinance and get a lower rate. Be careful, because a lot of times, if it doesn't happen, you'll be paying that higher amount for a longer period of time. Ooh, dealing with debt. So Lena just completed a 2-year technical training program. She's off to a great start, working as an independent contractor, paying off her student loan and second loan to buy a van. She just landed a project that requires specialized equipment. She plans to rent the equipment, but the vendor has offered her a good deal to buy instead. She needs a 3-year loan to buy it. Could she use the equipment on future jobs too? So she needs a 3-year loan to buy it, but she could use the equipment for future jobs. So that's a benefit of it. Given Elena's situation, which decision do you think is best for her? I'm going to let you guys read it a little.
I think 1.
1.
Yeah,
So
I'm gonna
number
go.
1.
Yeah, number 1.
Okay. So number 1 is rent.
Oh, and 3. Well,
And
between
3.
1 and 3. I'm confused. Yeah.
Okay. So number 1 is rent. Before taking on any more debt, she should make sure that she can handle all her new expenses. And 3 is determine the new loan payment amount. Only proceed if it fits her budget. Ooh. And let's see. I'm going to scroll up a little bit. She just completed school. She's working. She's paying off student loan and a second loan to buy a van. And she just got a job. So she already got 2 loans, and now she's thinking about getting a 3rd one. So let's see. I'm going to choose that first one. I think I got more people. And let's see. Yep, the first one. Elena says, I'm so glad I didn't borrow more money. Even though I'm getting a lot of work, my expenses are higher than I thought they would be. If I had borrowed more money, it may have been tough to repay my other loans, to maintain a good credit score history. I got to pay all my bills on time, otherwise I'll lose money in late fees and my credit ratings will go down. So that was a great decision for her. Using credit wisely. And it looks like we're almost getting to the end here.
Being able to borrow money when you need it can give you financial flexibility. But if you're not careful with credit, you may end up buying more things and spending more for them than you would if you paid in cash.
So watch out. Owing more than you can repay is painful. Having too much debt can damage your money situation for years.
The best defense is to avoid too much debt to begin with. Otherwise, like me and millions of other people, you'll have to learn the hard way how difficult it can be to pay it off.
We don't want it to happen to you. We'll give you the warning signs of too much debt and some guidelines to avoid debt problems. We'll give you suggestions for dealing with debt if you're having problems now.
All right. So tips for using credit card wisely is to shop for credit. Shop around for credit cards with a low interest rate and low or no annual fees. Look closely at credit card offers that use the word free. Usually everything has a price. Avoid loans and credit cards with high interest rate. Don't take on monthly loan payments that you cannot afford. Plan your shopping. Don't use your credit card to buy things that you can't really afford. Let your budget be the guide, so you want to resist impulse buying. Set limits. Don't go wild. Don't exceed your credit card spending limit, and try to keep your balance 70% or less of your limit. Avoid having monthly credit card statements that exceed 10% of your monthly net income. Don't let the total amount you charge to your credit card exceed 20% of your yearly net income. Maintain a number of credit accounts over a long-term period of time can actually improve your credit score, but only if you limit your credit use. You want to keep track of everything. Keep your receipts, check your statements, make sure they're accurate. Pay on time. That's going to be the key thing. You want to pay your credit cards and bills on time. Contact creditors. If you see anything wrong, reach out to them. And then also you could try asking them if they could lower your APR. Get help early if you're having any problems. And the key to financial freedom is living within your income. That means not borrowing more than you can afford to repay. Okay, warning signs of too much debt, your timing. You're always late paying your bills. It takes you 60 or even 90 days to cover bills once you could pay monthly, and you juggle payments to keep creditors satisfied. So, paying Paul, stealing from, I always say it wrong, but taking from one account to another just to try to keep everything going. When you're juggling, that means you got too much debt. Your checking account is overdrawn, or you could only make the minimum payment for your credit cards. Your paycheck, you're ready to deposit your paycheck because you've already written checks that require the money to be in the account. A small reduction in your income or unusual expense would make you unable to pay all your bills on time. Your credit accounts are usually at their maximum limit. You apply for more credit cards because you have reached the limit on the ones you already have. You are spending more than 20% of your take-home pay, not counting rent or mortgage, and your loan or credit card balances stay the same or go up each month. You're still paying off purchases you made a year ago. Yeah, if you have a credit card and you haven't paid it off within a year, there's a problem. You put off medical and dental visits because you can't pay the bill. You don't have a savings account, or you stop making deposits. You're always worried about debt. You argue with your spouse or partner over bills. You sometimes wonder why you made certain purchases. You feel free to spend more after clearing up debt. As far as your living expenses, you use savings or credit cards to cover everyday expenses such as groceries. And you're ignoring phone calls and mail because people are asking you, when are you paying us back? So you don't want to be in any of those situations. What you want to do when you're dealing with debt is ask for help. Some lenders will have debt counselors that can help you. You can also reach out to the Consumer Credit Counseling Service to see if they can work a repayment plan with creditors. Have a written plan. Know how much money all your bills are, and have it all figured out. And then contact your creditors to see if you get lower rates or to work on a payment plan. Pay more than the minimum each month. Don't take any new debt. If you already got 2 loans out there and they're newer to you, take your time before you take on more debt. And minimize rates and fees. And don't give up. Reducing your debt is a challenge, but don't stop trying. It's one of the most important things you can do. And then we're almost at the end here. Let's watch one more video. What can you start doing today?
Good credit can give you financial flexibility and options.
First, shop for a credit card with a low annual fee and low interest rate. Every month, pay at least the minimum payment due and more whenever you can. Pay off your balance as quickly as you can.
Second, if you apply for a loan, shop around. Look for a lender with a good reputation. Understand the terms of the loan agreement before you sign.
Third, order a free credit report and find out your credit score. One of the best ways to improve your score is to always pay your bills on time.
Finally, remember that the key to financial freedom is living within your income. Never borrow more than you can manage to repay.
If you find yourself in trouble with debt, take action early. Call your lender and work with them to decide your next steps.
All right. Can everybody hear me?
Yes.
Yes.
Miss Tanga, are you
Oh,
speaking?
sorry.
Okay, because
Yeah,
if you
but-
were speaking, we couldn't hear you.
No, go ahead. I was just going over the points, but go ahead because I know we're at the bottom of the hour. There was a quiz, but we can either do the quiz or we can wrap it up.
We can wrap it up. Everybody, I'm going to do a quick roll call. I know some people had to leave because they had places to go, but I'm going to do a quick roll call really quickly. Amir Wilbert, Anaya Jackson,
Here.
Christian Alejante,
Here.
Elijah Elor,
Here.
Emily Cross,
Here.
Giselle Childs,
Here.
Jaden
Okay.
Allen,
Here.
Leah Lopez Jackson,
She had to leave.
Luna Lopez Martinez.
Here.
Great. Marilyn Terrell,
Here.
Nyla Parker, she can't speak. Nija Bunch, Sydney Harris, and Zaire Macklin. I know some people had to go. I was on earlier. So thanks everybody for joining class
Do
today.
you have a treasure?
And I have Treasure and Leah down.
Yeah,
And
okay, good.
I have someone named Yeruna, Eruna, Erinuna. And
Miss,
I
did you get a mirror?
Huh?
I'm here too.
Did you get a
Okay.
mirror?
Okay, Arena, am I saying that right? Okay, Arena Washington. Okay, and there was a young lady named Bubbles on, but I didn't know what her real name is because I don't have Bubbles down on my list, but we'll check back with her next week. Okay, everybody, great class today. Thank you to our wonderful instructors, Ms. Tanga and Mr. Rayford. We have 2 more sessions left, 1 more session next week, and then the final class is the final assessment. On the assessment, you have to receive 80% or better to pass the class. And then at that time, we will ask you to send in, if you already have a savings account, you will send in a copy of your savings account showing us that you saved up to $200. And then Mr. Rayford will write you a check for $200. But if you haven't opened up your savings account yet, we encourage you to open it up by the end of the class and deposit $200 so Mr. Rayford can give you a check for $200. And by the way, after we take the test in 2 weeks, the actual final week, we're going to visit Ms. Tanga's bank. So we will be visiting her bank as the final conclusion to the class after the exam. So anyone have any questions? Anyone?
Miss, did you say my name? Amir?
Amir Wilbert?
Yeah.
I did. I said it first.
Oh, my bad. I was away from my computer for like a little second.
No problem.
Did you mark me too? Did you mark me here too?
Sydney Bunch,
Sydney Harris.
Sydney Harris, let's see. Sydney Harris, yes, I said your name as well. And I do have you marked in.
Okay, thank you.
Okay, Miss Tango or Mr. Rayford, take it away.
Ms.
All
Tanga?
right, and I just want to say thank you for joining today. I appreciate you every morning showing up and wanting to learn more about finances. This is what's going to be your future. It's going to help you. Mr. Rayford.
Yes, and what I, again, encourage you, and I'll hopefully remember to encourage you every week, please talk to your friends about what we're discussing. This will be ingrained in you the more you talk about it. And please talk to your parents, okay? God bless everybody. Thank you, Ms. Tanga. I appreciate your help. Thank you, Rhonda. I greatly appreciate your help for reminding me every week. So God bless everybody. Be safe.
Bye-bye. See you next week.
You as well. All right. Goodbye.
Bye-bye.
Thank you. Have a good week.